Hey there, fellow investors. Today, we're diving deep into the world of Warren Buffett, the Oracle of Omaha, to uncover his secret sauce for finding undervalued stocks. Buffett's investment philosophy centers around a powerful concept called intrinsic value. Think of intrinsic value as the true worth of a company, like a hidden gem waiting to be unearthed. It's about looking beyond the daily stock market noise and understanding the underlying strength and potential of a business. Why is intrinsic value so important? Because it helps us identify stocks that are trading for less than they're actually worth. It's like finding a dollar bill for 50 cents. By investing in undervalued companies, we position ourselves for potentially significant returns when the market eventually recognizes their true value. Buffett's approach is all about buying great businesses at reasonable prices. He's not interested in chasing short-term fads or making quick bucks. He's in it for the long haul, patiently waiting for the market to catch up to his insights. And that's what makes his strategy so powerful and enduring. So how do we go about determining intrinsic value? That's where things get interesting. Buffett relies on a combination of financial analysis, business acumen, and a healthy dose of common sense. In the following sections, we'll break down the key elements of his approach, providing you with the tools to start thinking like the Oracle himself. One of Buffett's favorite tools for estimating intrinsic value is discounted cash flow, DCF, analysis. It's not as intimidating as it sounds. DCF estimates the present value of a company's future earnings. Think of it like this: a dollar today is worth more than a dollar tomorrow, because you can invest that dollar today and earn interest on it. DCF analysis applies this concept to a company's future earnings. It discounts those future earnings back to today's value. Now I know what you're thinking. Predicting the future is impossible, and you're right, it is. But DCF is about making educated guesses. It's about using a range of scenarios to assess potential risks. Investing is about making informed decisions based on sound analysis. And DCF is a valuable tool that can help us do just that. When it comes to evaluating a company's earnings, Buffett doesn't just rely on the net income reported on the income statement. He digs deeper, looking for a metric that provides a more accurate picture of the company's true profitability. This metric is called owner earnings. Owner earnings represent the cash flow that a company generates from its operations that is available to its owners. That's us, the shareholders. It's calculated by taking net income and adjusting for non-cash expenses like depreciation and amortization, as well as for changes in working capital. Why is owner earnings important? Because it cuts through the accounting noise and gives us a clearer view of how much cash the company is actually generating. This is crucial for understanding the company's ability to reinvest in its growth, pay dividends, or buy back its own shares, all things that can benefit us as shareholders. For example, imagine two companies, both reporting the same net income. However, one company has significant capital expenditures each year to maintain its aging equipment, while the other company has minimal capital expenditures because its equipment is relatively new. Looking at owner earnings would reveal that the second company is actually generating more cash that can be returned to shareholders, even though both companies report the same net income. By focusing on owner earnings, Buffett ensures that he's investing in companies that are not only profitable on paper, but also generating real cash flow that can be used to create shareholder value. Section 4. The discount rate, pricing risk and opportunity. Now, let's talk about the discount rate, a crucial element in DCF analysis. The discount rate represents the minimum rate of return that an investor expects to earn from an investment, given its risk profile. It reflects the opportunity cost of investing in one asset over another. Think of it this way: if you could invest your money in a risk-free government bond and earn a 5% return, you would need a higher potential return to justify investing in a riskier asset, like a stock. The discount rate reflects this risk premium. The higher the perceived risk of an investment, the higher the discount rate. Conversely, the lower the perceived risk, the lower the discount rate. When performing a DCF analysis, we use the discount rate to discount future cash flows back to their present value. Choosing the appropriate discount rate is crucial because it directly impacts the intrinsic value calculation. A higher discount rate will result in a lower intrinsic value, while a lower discount rate will result in a higher intrinsic value. There are different methods for determining the appropriate discount rate, but a common approach is to use the weighted average cost of capital, or WACC. DUACC takes into account the cost of debt and equity financing and weights them based on the company's capital structure. Section 5. Margin of safety, Buffett's safety net. One of the hallmarks of Buffett's investment philosophy is his emphasis on margin of safety. This concept, popularized by Benjamin Graham, Buffett's mentor, is all about building in a buffer to protect against potential errors in our analysis or unforeseen circumstances. Remember, investing is not an exact science. We're dealing with incomplete information, constantly changing market conditions, and the unpredictable nature of human behavior. The margin of safety acknowledges these uncertainties and provides a cushion to absorb potential losses. Buffett likes to buy stocks when they are trading at a significant discount to his estimate of their intrinsic value. This discount represents his margin of safety. The larger the discount, the greater the margin of safety. For example, if Buffett estimates a company's intrinsic value to be $100 per share, he might only be willing to buy it if it's trading at $70 per share or less. This $30 discount represents his margin of safety. The margin of safety is like a safety net for investors. It helps us avoid big losses if our analysis turns out to be wrong, or if the market takes an unexpected turn. By buying stocks with a margin of safety, we're essentially buying dollars for less than a dollar, increasing our chances of generating attractive returns over the long term. Section 6. Calculating intrinsic value, a step-by-step example. Let's walk through a simplified example using a fictional company called Buffett's Burgers. Assume Buffett's Burgers generated $10 million in owner earnings last year. We'll project a 5% growth rate for the next 10 years. We determine an appropriate discount rate of 8%. Using a DCF model, we discount the projected earnings back to their present value. Assume a perpetual growth rate of 3% after 10 years. We'll use a perpetuity formula to calculate the terminal value. Discount the terminal value back to its present value. Add the present value of projected earnings and terminal value. Assume Buffett's Burgers has 10 million shares outstanding. Divide the total present value by the number of shares to get the intrinsic value per share. Our calculations result in an intrinsic value of $80 per share. If trading at $60, it's considered undervalued. This is a simplified example for illustrative purposes only. Real-world calculations involve more complex assumptions and analysis. Section 7. The Buffett Way, a timeless approach to investing. Warren Buffett's investment philosophy, centered around intrinsic value, has stood the test of time. By focusing on understanding the underlying economics of businesses, practicing patience and discipline, and always investing with a margin of safety, Buffett has consistently outperformed the market over the long term. While the specific tools and techniques used in intrinsic value analysis may seem daunting at first, the underlying principles are surprisingly straightforward. It's about buying great businesses at reasonable prices and holding them for the long haul. Remember, investing is not about getting rich quick. It's about building wealth gradually, over time, by making sound decisions based on thorough research and a deep understanding of the businesses you're investing in. So there you have it, folks. The secrets of Buffett's success are out in the open. Now it's up to you to put them into practice and start building your own path to financial freedom.